All right, welcome. Like I was saying, this is our weekly loan desk meeting. So we've got our fabulous loan desk team here with us today. And so we're going to be going over low down payment programs. And so this is going to be a really great opportunity to keep your clients informed as agents. And so Joe, who is kind of heading the loan desk team, is going to be able to talk more about the programs that are offered and some ways that you can share that knowledge with your clients.
Thanks, Hila. Hey, everyone. Just want to go over low down payment products. I want to do maybe some comparison of different products. You know, this is a time where there is more home affordability products out there than I can ever remember in this industry. And in some ways, it's great, but in some ways, it's kind of overwhelming. And as a loan officer, because you got down payment assistance programs from the government, you've got home affordability products from Fannie Mae and Freddie Mac, you have products that are income based, you have products that are asset based. And then there's local products like City of San Francisco has its own product. So there's all kinds of initiatives to enabling home ownership. And I think that, cities, governments, and government-sponsored enterprises like Fannie Mae and Freddie Mac have realized that often the biggest hurdle to enabling homeownership is the down payment. So putting all of that aside, all those programs available, let's just have a quick pop quiz, and feel free to join. Feel free to just chime in. On an FHA loan, what is the minimum down payment requirement for someone who has a 580 credit score and above? So the minimum down payment for an FHA loan is 3.5%. Yeah, Joel, you're too slow.
I'll get it.
3.5%. Okay. All right, 3.5% on an FHA loan is the minimum down payment. All right, what is the minimum down payment on a VA loan? Kelly, feel free to, if you want to type it in the chat, that's too, I can see that.
I think, did I say zero?
0% down, you got it. And a lot of people don't realize that that VA, you can go above the loan
Sales
limits.
price.
Yeah, and then so you can also have the finance fee rolled in. There's lots of advantages to VA. So FHA and VA loans, they are government-backed programs, meaning like the government, Ginnie Mae is the name of the government trading desk that basically buys these mortgages from name any lender that does VA and FHA loan. So in order to do an FHA loan as a lender, you've got to get your certification. You have to have $2 million net worth, things like that. You got to go through all these requirements to be able to originate FHA loans, and then you can sell the loan directly to the government. Now, a lot of folks, the reason why they will get their FHA and VA lender license is, and I'm just kind of getting sidetracked here, but a lot of lenders, they'll do that because you can earn high margins on those government-backed loans. Like you'll look at some lenders, they'll earn like 4 to 5% on those loans. So it's really important for FHA and VA mortgage applicants to shop around extremely aggressively. I would say if there's 2 loan programs that are basically standardized that vary the most based on the pricing, which therefore impacts the interest rate and the cost, it would be FHA and VA. You could go to one lender and they could be charging a 7.5%, and you go to another lender and it could be as low as like 6.5% at the same exact closing cost. You don't see that as frequently in conventional. Because the margins tend to be lower and there tends to be more competition. So therefore, you don't have these outliers charging 5, 6, 7 points on FHA or like they do on FHA and VA loan. So a mission of mine is always to educate veterans to shop, 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 because it could be really a big difference in rates based on who they go with. Okay, let's do another one. Putting aside any sort of home affordability product, does anyone know the minimum down payment under a Fannie Mae or Freddie Mac backed mortgage?
Is it 3%?
3%, you got it. A lot of people think it's 5%, but it's not. It's 3%. So it's actually less than FHA. Now, the more you put down, the better your mortgage insurance is, the premium that you pay on conventional. Whereas with FHA, doesn't matter how much you put down. The mortgage insurance, well, it's slightly different, but basically it's the same. With FHA, the mortgage insurance, it changes by 5 basis points if you put more than 5%, 5% or more down. Okay, and then so now we're like, okay, we have a job where it's basically our job as loan officers to try to navigate all these different products. So one of the things that we like to do is basically run kind of a product comparison. So we're going to just do a purchase. We're going to say it's a single family home. We're going to say it's a primary loan amount. And right now we're not even going to get into like area median income limit, but let's just make it real simple. We'll do $500,000 purchase price, and we'll put the down payment as 3.5%. And so the loan to value is 96.5. And then we can eliminate the home equity loans, and we'll see that. So the FICO score, we could just put the FICO score here at 620. And okay, so let's start, and then you can get even more granular, but let's just start here with a very basic $500,000. Let's say somebody's got $20,000 saved up for a down payment. So they could go FHA, they could go conventional. All right, what do we do here? So you can see here the list of requirements. So you have all these different loan product types. So you have Fannie Mae, you can see the minimum credit score 620, the max loan to value 97%. You have the max DTI. You have FHA. So what this means is FHA approved eligible means you get approved findings. What you'll find is that FHA for most applicants will allow for the loan to be approved up to 56.9% DTI. So FHA can actually go higher than conventional, which you're usually capped at 50%. And again, it does depend on the getting that approval from the automated underwriting system. All right, so we have this scenario. So we went over this. We have Fannie, which is essentially conventional conforming. We have FHA. We have VA, and you can see the requirements. Now this is with Rocket Mortgage, so like this VA 640 credit score, that's not a requirement. So VA actually goes down to 500 credit score. So we work with lenders that will go lower than this. So this is sometimes lenders will have what's called overlays, where they will go above and beyond what's required than what the investor requires, which is in this case is Ginnie Mae, since it's a VA loan. So now let's talk about home ready and home possible. So essentially, if you're earning in less, basically 80% of the area median income, you may be able to qualify for home ready, home possible. So let's run the numbers here. Okay, so this is a nice calculator. So we can see 80% of the area median income of Orange County is $84,160. You can see the county loan limit. Remember, I almost start every call now. I say, hey guys, remember the county loan limits have changed for 2024. So you have 1,149,000 for conforming, and you have 1,149,000 for FHA. So if you have somebody in Orange County who's earning less than $84,160, and this is gross, then they would qualify for home ready and home and potentially even um, home possible. And the reason why this is important is because then the interest rates are better. So let's go check rates. So we'll do pricing. All right, so let's say we have somebody who has decent credit, and so we're gonna take the income, so 84, so that would be, let's say that would be $7,000 a month would be less. And let me just look up a zip code in Orange County. So do 92801 Orange County. We're not even going to select. We won't select the loan type. We'll just keep it, let's say $500,000 purchase price, and we'll do we'll keep it at 96.5 so we see FHA options. Okay, say first time home buyer, client paid. And for now we'll just see the wholesale rate. So we'll just put it at 0. Second mortgage, no. And say single family home, primary residence. Let's run the numbers. So I'm kind of giving you kind of behind the curtain what the loan officer is doing. They're basically taking in all the data. What a good LO should do is they should listen to the goals of the client. Then they take in all the data from the client, and then they present options that best align with the goals of the client. That's what a good LO should do. And knowing this, they need to know all these programs. So we're going to go through a few different ones. We'll say home possible, home ready. All right, let's do this one. We'll do borrower smart, 30-year fixed. Okay. And so you can see here we got a breakdown. Now, let's see. Okay, so the DTI 80%. So here I might have to change the loan amount here. Okay. All right, so let's first just look at a conforming loan. So we have a conforming loan, and for this client, so you can see wholesale rate 6.125 with a 151 PMI. Okay, now let's add for including an FHA. So we'll just do 3 option comparisons. Now we're comparing conforming with FHA. This is often a discussion I have with clients. Should I do a conventional loan or an FHA loan? And so you can see here that the interest rates are lower with FHA, but the PMI is higher. And then also a drawback with the FHA is you have a 1.75% mortgage insurance that gets rolled into the mortgage. So you basically just lost $6,755 of equity, plus the mortgage insurance does not drop off once you get to 80% loan to value. So there's some pros and cons. And again, that's why I said the first thing is to listen to the goals the client. How long are they going to live in the property? Is this their forever home? Do they expect to pay the mortgage faster than just the bare minimum? Is their goal to actually own the home free and clear? Basically all those things are pertinent information to best advise, which loan program makes the most sense. So you can see here with conventional, it does not have that upfront mortgage insurance. But let's say this person, and this is what I'm always checking, is let's say this person's income is at 80% of the area median income. Now let's do a comparison, or we'll just do a home possible program. So you can see here that the mortgage insurance now decreased under the Home Possible program. So it was 151, and now it's 120. So basically, by this person having their income being less than area median income limit, they're getting slightly better pricing. I think this would greatly improve if they had a kind of a worse credit score. But basically, the big difference is now they have a lower PMI. So that saves them $30 a month just by doing that. And I'm telling you, this is happening where loan officers are putting this borrower into this program, conforming 30-year fix, when they could have qualified for this program, Home Possible, Home Ready. And you say, oh, well, like, what's the problem? Like, well, the problem is now they're paying $31 extra a month on their mortgage insurance when they didn't have to. So this is why, a good LO can really help save a client money, especially when it comes to these low down payment programs. And you can see here that you have, like this is with a 3.5% down. Now, since I think many of us are in California, let's deal with some higher numbers here. So a lot of people don't realize that the minimum down payment on jumbo loans for many lenders is 10%, or it's technically a 10.01%. So let's run the numbers here on a jumbo loan, 89.99%. So a client is buying a $2 million home, essentially $1.8 million, but you do have to put in that extra 0.01. I don't know why. It's just that's what the investor came up with. So, but it's basically 10% down. Let's run the numbers. 740 credit. Oh, got to update the income. Let's say this client is making 30K a month in combined income. That may not even be enough. Let's say 35,000. And all right. So now we have jumbo loan could potentially go. Now the rates are higher, but potentially that is an option to do a 7.75. And ideally they'd have a higher credit score. I think they're getting hit here. Yeah, with that, if you're doing a high loan amount, you really want your credit to be in order. And someone who's buying a $2 million home, ideally should have good credit. Okay, actually, no, looks like it's the same. All right, so again, but it's an option. So let's go over another product comparison. I want to go over the Freddie Mac Borrower Smart. County. Feel free to chime in if anyone has questions. So I mean, you could spend all day on like this Pathfinder trying to educate yourself on different programs. So now we're going through the home affordability program. So we have a 1% down program, 2% grant from Rocket, who's going to be our primary partner. And in this, it has reduced mortgage insurance. But you can see here, this is not designed for California so much, because the max loan amount is $350,000. Do we have anybody on the call that's not in California? Anybody in Texas, Georgia, Florida?
Me, I'm Kelly's. I'm in South Carolina.
Okay. Are there any deals where like the loan amount is 350 or less?
Absolutely.
Okay, you should really know about this program. It's basically it's for someone who earns 80% or less. So AMI is 80% or less, and I just kind of went through, like, hey, give me your zip code, or give me which county are you in, Kelly?
Beaufort County.
Okay, so Beaufort County, 80%. Wow, that's kind of surprised as to how high that is. So 80% is $82,640. So if you got folks who are making less than that $82,640, and they're buying a property where the loan amount is less than 350 or less, they can potentially qualify for this 1% down program and get a 2% grant, and you get reduced mortgage insurance. So it's like, as good as you could kind of ask for client. Yeah, yeah. All right, anybody else outside of California?
So I do have a question.
Yeah.
What would be a driving indicator or reason why a loan officer would not look for those type of products to service those that make less than that median?
Reason was probably laziness, to be honest with you, because I think many loan officers, they get, they're like, they have a hammer and they want to make everything look like a nail because that's just what they know that they can do super efficient. And if they have to try to learn a new product and go find the county loan limit, so that's why a lot of like what I do is try to make tools that are just easier to identify these opportunities. But imagine if you worked for a lender or a broker or bank or whatever, where it wasn't really clear or you didn't know how to do it, then it just requires so much effort to figure it out, and they may not even know. All right. Okay, so here's what I wanted to go over, this purchase plus. Do we have anybody? So here's all the counties where this, so we're getting like, from what I'm trying to do is say broad to narrow. Broad is FHA, VA, conforming. These are all pretty low down payment programs to begin with. Put aside any sort of like assistance. And now we're getting more narrow. So if it's a 350 loan amount and it's AMI, then okay, can maybe do 1+. Okay, now it goes county specific, and this is under Fannie Mae. So there are areas where all the person has to do is currently live in that area, and the property has to be. So if they're currently living in Naperville, like, or parts, and then again, this is actually census, so it says Chicago, but it gets more specific. So there's a way to look this up. I've saved this census map. Here, I can open it. So if you have clients who are living in, and what's interesting is this actually came out for areas of California. So Riverside, San Bernardino, Ontario counties, if you have clients who are living here, they are able to qualify for a grant of $5,250 that can either go towards the down payment or closing costs, and they can get a credit of $500 for the appraisal. The minimum down payment is going to be 3%, and basically you get that $5,250 grant. And all they have to do is actually live in these properties. The cool thing about this Fannie Mae program is it's not income dependent. They just have to live in one of these eligible metro areas, and then we can compare in like the census tract. So like you have to go into this census geocoder. I'll be honest, like I've done a few of these, and every single time, like going back to your question, Kelly, like every single time I still have to like figure out, okay, how do I make sure that this property is eligible for this credit? Because it's pretty specific. in that you have to look it up in this census geocoder. So basically, if you have the address, so now when I get a client and they like live in Riverside, this is in California, if it's Riverside, Ontario, San Bernardino, I will take their address and I will plug it in here to see if they're eligible for this $5,250 credit. So that is another program, but it's not just for, there's a lot of areas that are now eligible. So Houston, the Woodlands, Sugar Land, McAllen, Edinburgh, Mission, all areas of Texas, Dallas, Fort Worth, Arlington, Brownsville, lots of Texas areas, San Antonio. And they just added Fannie Mae, more and more areas that were eligible for this program. So essentially, you can get $5,250 forgivable grant. Great marketing material too if you're located in that area. I feel like I've kind of went through a lot here, and what I could do is maybe even put this into if this is helpful, is I can put this into a deck and send it out saying, hey, here's all the loan programs kind of in that matrix that I first showed you, how to see if you're eligible to qualify, because we haven't even gotten into all the state level programs. So there's Cal HFA. Raul, we have 3 minutes. Do you want to share a little bit about Cal HFA since you've done more of those loans than I have?
Oh, I know you were going to ask me at the end. Yeah, so Cal FHA or Cal HAFA.
Raul, you're breaking up here, so I'm going to just cut you off. But basically, Cal HFA
is a pretty cool program in the state of California where you could do an FHA or a conventional loan.
Yeah, Raul, you're kind of breaking up here, but essentially that 3.5% down for an FHA loan, that could be a forgivable grant from California. So it would be a 0% down. Now the borrower still needs money for the closing costs. FHA requires property taxes and homeowners insurance to be escrowed in, and depending on the month of closing, that could actually be a pretty significant, balance due. So when we look at a bank statement, we're not looking for like zero assets. Like if we have that, I'm like, hey, this isn't going to work. So you still need some assets in the bank to qualify. And ideally, a client shouldn't be buying a home if they're like running overdrafts. Like that's always, whenever I look at a new application, the very first thing I always look at is assets, because you can just learn a lot about the client just based on the bank statement, and then you also know which area, what type of programs they would be able to qualify. There's loan programs where you can qualify without any income as long as you have requisite assets. But essentially, that Cal HFA is the 3.5% down. There's all sorts of local programs. San Francisco has local programs. Los Angeles County has local programs. And so one of the things that we're going to be doing is really try to aggregate all this data and bring it to you guys so that you're able to market to your clients more effectively. Because I still feel like there's a lot of misinformation out there from potential home buyers as to how much money do they need to buy a home. Now, with rates up, the income is probably going to be higher maybe than what they think. The payment's going to be higher than what they think. So that's kind of the bad side. But the good news is there's lots of programs for putting less down. All right, Ela, I will pause there since we're at our 1 o'clock stop. And Joel, let's maybe put this together on a slide because I really enjoyed this topic.
Absolutely. We'll definitely have to continue this conversation in another room, but thank you everyone so much for joining us this week. We have these LoanDesk rooms every week at this date, at this time. So feel free to come back and join us. And I hope everyone has a great rest of their Tuesday. Thank you so much.
Thank you.
Thank you.
Yes, I'll look forward to the deck. Thank you.
Thanks, Anna.